Okay, this week we're going to waste no time. We're going to get right into it because we got a lot of things to cover today, a lot of stuff about kind of figuring out your own risk tolerance and stuff like that. So we're not going to have a review of last week to start with, but that's because as we wrap up today, we're also going to be wrapping up sort of phase two, the big section about investment portfolios. So we'll do a whole recap on pretty much everything at the end of this class. That'll include last week and everything we've talked about so far. And I have a couple ETFs I want to talk about. I want to talk about the ETF Prime podcast that I've been listening to a little bit recently, and just talk about a couple things that are happening in the ETF world. And I think that'll be something that we can introduce at the end of class more frequently so that we can talk about some new products and things that are happening out there. So today, what we're going to talk about is we're going to start talking about your investment objectives, risk tolerance, and some example portfolios for them. Because what we've done so far is we've talked a lot about technicals, we've talked a lot about individual investments, we've talked a lot about how to evaluate them on their own and how you might fit them into a portfolio, but we didn't really talk about that starting point when you choose what am I investing for, what kind of risk am I taking on, and what kind of portfolios fit that. And the reason for that, generally people do this the other way around. Generally they'll start here and then they'll teach you everything else afterwards so that you can kind of fit it all together. But personally, I think this is a really good way to wrap it up because you get all the tools that you would want to use, and now you get to learn what direction am I using all those tools to move towards. And it makes a lot of things click, and a lot of the things that we've talked about, the relative risk, just things about market risk and all these sorts of things that can help you get in the right direction for your portfolio. So advisors and investment firms tend to use standardized terms to refer to general asset allocations and investment purposes. And so that's what we're going to be talking about today. A lot of the stuff that I pulled was from things that kind of get handed down to us from our broker dealer as how they categorize investments and categorize investor profiles. So your advisor has probably, if you have one, assigned you to one of these categories, and they may or may not have described what it is or described its meaning to you. So we'll go through those a little bit more today so that if you see on your statements or with your meetings and your financial advisor something like current income or moderately aggressive or any of these sort of keywords, you can have an idea of what they're actually meaning. So knowing the category of investor that you fit into, it makes portfolio construction or choosing from a model or a pre-built portfolio, because there's nothing wrong with that, way simpler, because you can get a really good idea of this is how much risk I want to take on, and this is what's going to be comfortable for me and is going to suit my needs. So there's two key terms that are used to determine the investment suitability. So whatever it is that we're looking at, whatever collection of equities, bonds, any of these things that we've talked about before, there's two things that go into really determining what kind of basket of securities you're going to use in your investment portfolio. And that's your objective and your risk tolerance. And to be honest, they kind of are almost the same thing in a lot of ways, because some objectives will be better suited towards certain risk tolerances, and certain risk tolerances basically come from an objective. So anyway, we'll get into that a little bit more later. But the objective is basically asking the purpose of the funds invested. What are we trying to do here? What are we doing with these assets? If you've got $1 million, are you trying to turn it to 2 million, or are you trying to shoot off some number of income through the life and drag that asset down to zero, and that's its use case? There's a couple different things that we can do. So generally, this describes what types of asset classes will be used in the portfolio. So you can kind of think of it as objective will tell you how much stocks and bonds am I going to have? Am I going to be completely weighted to stocks, or am I going to be completely weighted to income securities, which could be a little bit of stocks? And then when you look at risk tolerance, it's basically saying how risky are we going to get with those investments? Like if I have all stocks, am I going just total market indices, or maybe a lot of value stocks and kind of playing it a little safer than I could? Or am I getting as aggressive as possible and picking all of the speculative sectors and just taking complete gambles on every single one of my positions? Because that's a thing you can do. So a maximum growth portfolio will be comprised of mostly all growth equities. Like you're not going to see much. If you're doing maximum growth, there's no reason to be looking for dividends. There's no reason to be looking for income, because the whole point is you want to be in companies that are going to grow their market share so that their valuations increase. But if you're looking for an income portfolio, you're usually looking for a mix of dividend stocks and bond funds. Dividend stocks because you can get a little bit of income, but you're also getting inflation protection, and bonds because that's where most of the income is most of the time. So risk tolerance will basically determine how much volatility are we talking about? Like when we're looking at the standard deviation that we learned about previously, it's basically how far are we stretching out that band? Do we want to stay in a nice little narrow corner where we know not a lot's going to happen? We understand we're not going to fly up with everybody else, but I'm just staying in my little corner and I'm very happy and I'm just like, I'm not worried about anything. There can be fires raging around me, but I know I'm okay. Or are you willing to sit through much greater volatility and actually go up with everybody else and really feel the growth? So again, you can kind of think of this as the emotional component. That's what I like to think of. I like to think of the objective as what am I investing in? What tools am I using? Quantitative things. And then for risk tolerance, really that's just kind of, I'm judging like how are they going to feel when all these market fluctuations happen, and how can I kind of put some padding on the sides or just let loose and let it go because they're not going to worry about it. Yeah.
Said in the last class that over time, it's always a good thing.
Yes.
But for retired people, we don't have that much time.
Absolutely.
What would be a general split in general?
So generally something right down the middle, which is yeah, something right down the middle. It might be 50-50, it might not be, but what I'm generally looking for is not necessarily a perfect split of stocks and bonds. Like that's not necessarily what I'm looking at. I like to look at the risk measurements. So standard deviation is kind of one of my favorite one to look at because it's just a raw measurement of how much volatility is there. We like to have somewhere around a 10 standard deviation. You could go down to 9 or 8, maybe up to 11 or 12, but somewhere in that general area around 10 tends to be, market will have closer to maybe 17, 18, 19, 20. So if we have right about half of that, that tends to be where you get a lot of decent inflation protection over a sort of intermediate period of time, but you're not having such intense short-term volatility that it's, it's ruining your possibility for income or taking distributions or all that sort of thing. And it's also just kind of having those special use cases. So if I know that this cash is required, whether that's distributions for income, I'm just going to set it aside outside of that investment plan. I'm just going to put it in a nice little short-term government bond fund and let it sit and earn interest and let the rest of this do the work. That's kind of where I'm at. Yeah.
Let's take it a little bit further. Like I get Social Security, I get a pension for my.
Mm-hmm. Yep. Mm-hmm.
Tax liability.
Sure.
Because I like paying them.
Absolutely. Oh, I understand.
So I'm thinking, I cannot. I have to pay taxes linked to produce a profit.
Sure.
So when I have to invest, then I want to shelter some of that in contact.
Mm-hmm.
So then I would go to maybe more bonds for some of my investments.
Yes, possibly. It kind of depends on what your overall picture is, but generally what I like to do, if we've got a lot of other sources of whether it's investment income, Social Security income, or pension income, I like to look at those as bond parts of my overall picture. So Social Security, for example, in the next several decades might not be as a high grade of like a secured income, but right now there's no concern that that's going to run out for somebody currently drawing it. There you go. So if we're looking at Social Security, we can think of that as basically a government bond that you never have to buy or sell out of, so you're not worried about the value. It's just it's basically a government annuity.
It's a criminal bond. I'm dead. Bond's gone.
Sure. Yeah. So I kind of like to think of it as like a government annuity, basically. Yeah. And so you can kind of think of it that way when you're looking at your investment portfolio. You can think, okay, so if you if you look into the market and you see interest rates and you say short-term bonds are still doing 5, so we'll just take 5 as an example. But if you kind of use that to calculate backwards and say, if a bond portfolio was shooting off 5% of income and it matched my Social Security, like how much of a lump sum would that be? You can consider that as like a big long-term government bond and go, okay, that has been accounted for. And if you're thinking you're sort of middle of the road, and then you think, okay, I've also got my real estate investment, you can kind of think of that as a riskier, maybe like a high yield or a junk bond. So it's got a little bit more volatility, some growth prospects, but it does still shoot off income. So in that point, I would probably be looking more towards growth. And then obviously, since you're tax sensitive, whatever bond positions I would do, like treasuries for the state write-off, and then municipals for the tax-free income is probably where I'd be. That's kind of what I would be thinking of. That's why I like to look at the whole picture and see how I can categorize other types of investments and think, all right, that's taking the spot of my government bonds here, or that's taking the spot of my high yield bonds over here, all that sort of thing. You can kind of relate other outside investments to stocks and bonds. And you can kind of think, okay, based on that, if I kind of say that that's accounted for, now what does the rest of my portfolio look like? That's kind of how I like to view those situations. Sure. So we're going to start with a couple investment objectives because they're the easiest to understand because it's really talking about what are we doing here? Like what is the objective? Like what does the dollar do? So firstly, we start with current income. And this investment objective means that the investor seeks investments with emphasis on income generation. They may elect to have some exposure to equities, but are primarily concerned with the preservation of capital. Now, one thing I will say is a lot of these definitions and a lot of these ideas of preservation of capital, they're tied to the ideas that bonds are safe. Now, granted, as we've discovered in the market and as we've talked about in our class several times, just because it's a bond doesn't mean it's safe. If you own the individual bond, sure, great. Close your eyes to the market, don't worry about it, and your principal will come back. But if we're talking about bond funds, because you don't own the underlying asset, you just own shares of the company managing that, you feel those fluctuations a lot more directly. It's like right to you, and it's not as fun. So just bear that in mind, that when I'm thinking of they're more concerned with preservation of capital and staying with income and bonds, I'm thinking short-term bonds. I'm not thinking about long-term governments or high yields or all that stuff. I mean, yes, I will diversify if it's going to be an all bond portfolio, but I like to just throw in a little bit of dividend stocks and stuff like that, income producing equities to give a little bit of inflation protection, because some of the risk that you can have with an all bond, like long-term bond portfolio would be greater and it would be more downside risk than upside potential than if you just sprinkle a little bit of equities in there on the end. Anyway, so that current income person is generally going to be somebody who says, I've got enough money. Let's just turn this into an income vehicle. If I got $1 million and I want to make 50,000 a year, whatever it is, and we just are putting it into these bonds and we're going to shoot off the income, maybe the dividend stocks, whatever else it is. I'm just taking the income out, not touching the principal, let that ride, and I'm just going to take my payments out. Or you could be drawing it down to zero over time either way. So balanced is what most people end up in. I'm sure a lot of people in here, if you have an advisor, you're probably in a balanced portfolio or something pretty close, because this is where most people end up wanting to be. Usually they want some sort of growth and usually they want some sort of income. That's just kind of where everybody lands. They get a little bit less volatility than the market, but they're still participating in a decent way. So this investment objective means that the investor seeks investments that are generally allocated among holdings that generate income, as well as those which offer the potential for growth of the portfolio, such as stocks and stock funds. The investor should understand that many stock and stock funds have an income component and are willing to utilize them to generate income. So again, it's just kind of saying, use everything for me, just a blend of all of it. Let's get the best of everything. Let's get that in there, generate plenty of income, but also give me plenty of growth. And like I mentioned before, risk level of this would be approximately half of a major index, maybe like 10 standard deviation, maybe 11 or 12, depending on how you want to tweak it a little more or a little less risky. But again, this is just kind of where most people are going to land. So if you're not sure and you're you think you want some growth and some income, just staying in balanced is it's a pretty good place for you to be because it'll give you the best of everything and give you some growth. Now, this one confuses me sometimes. Growth and income to me sounds the same as balanced, but it's just saying balanced, but tweak it up a little bit. Just turn up the heat just so slightly, basically is what that means. So this investment objective means that the investor seeks investments that primarily focus on growth of the portfolio, with some of the portfolio being allocated to income producing investments. So to me, I'd probably be looking that's really, to me, that's just towing the line right between growth and balanced for the most part. I don't really think of that as its own separate category. I just think of somebody who's balanced that says, I want a little more. So you're just really turning up that heat, a little bit more growth securities, and not so focused on tons of dividends and tons of interest payments and stuff like that. So growth is where we make really the next step up, because at this point, we're not really worried about income. This is the kind of person they're not taking distributions. It's probably not time for RMDs, or it's an investment that's just for somebody else. It's not even for you. So if you have something that you want to just go to beneficiaries, it's going to be a while. This would be the kind of thing where you want to grow that over time. So this investment objective means that the investor seeks investments with the majority of the allocation being comprised of investments that have a focus on growth of the portfolio with little to no emphasis on producing income. So for me, what I do with a growth portfolio is, instead of going, I'm just going to buy an S&P fund and call it a day, we'll do a very large position in something like an S&P fund, but then I'll also kind of, for what would be the income portion of it, I'd like to make that maybe some value stocks or the really risky bonds, like long-term bonds or high-yield bonds that I would not normally use for somebody who wants to be more conservative. I put them in here because with high-yield bonds, sometimes there can actually be a decent amount of growth prospects because the yield is really high. So when interest rates drop, those things do really well. When you're talking about, say, a government bond right now doing 5 and a high-yield bond doing 6 to 8, that 6 to 8 bond is going to rise in value a lot more than the 5 when interest rates drop by 0.5% or 1%. So maximum growth is where we start to get, that's where we start to get really fun. That's where we start, that's my investor profile, basically. I got tons of time. I'm ready to feel the volatility. Even if it doesn't work out for a while, I just keep dollar cost averaging, get in there, let it grow. So this investment objective means that the investor seeks investments which may consist of the entire portfolio in equities and are very willing to invest in securities that carry a significant degree of volatility beyond traditional equity market indices. So this is where you're going to go into those sectors that get really interesting. Like if you're thinking about crypto, I have a crypto ETF we're going to talk about later. If you're thinking about technology and you want to get really overweight in that, or you're thinking about some kind of nuclear energy, like this is the kind of investor profile that would be useful for, where you just want to take chances and you think this industry is going to explode or whatever the case may be. This is where that starts to come into play. Yeah.
Yeah, I don't know if you're going to get into this later, but you mentioned last week a lot about index funds.
Yes.
Are those growth or is that income?
Well, it depends, because an index, essentially all that an index is just, it's a way to categorize like a section of the market. So generally when people think of index funds, they think of an S&P 500 fund, they think of a NASDAQ fund. Those are straight growth. All day and night, that's a growth fund. It's like every day of the week, there's barely any income. They shoot off maybe like 1.2% of dividends on like a good year. But for the most part, those are straight growth. But you can have a bond index, like the best performing funds tend to be index funds, but that's just of any sort of category. So you can also have like mid-cap value, which could be, that's a decent amount of income. That's some dividend funds. You could have basically the bond aggregate, which is all bonds ever. You can have that as an index fund too. Short term, there's some treasury indices. There's all types of different companies like Morgan Stanley and I think JP Morgan is MSCI. I don't remember all the different names, but there's a whole bunch of places they publish these indices, and then essentially the ETF will just buy the ability to track that, and then they'll create their ETF following that index. So there's a whole lot of different indices, but on the general, if you hear somebody say the word index fund, they mean Standard & Poor's 500, or they mean NASDAQ 100. That's just kind of most of the time, that's what they're talking about. Okay, so now we're going to get to risk tolerance. And this is where we start to think, again, I personally like to think of this as more of an emotional component. So if I'm asking a client what they want to do with their money, how much risk they want to take on, I'm thinking objective. Like I'm thinking they're going to tell me what's the purpose, what are we doing, like what do I want to do with these dollars? That's where I'm going to kind of take their word for it and be like, okay, we're going to start here. And then risk tolerance will be a little bit more of an evaluating conversation. Just seeing how they talk about risk, seeing how they talk about volatility, kind of getting their opinion on what these different things mean, big market fluctuations, and kind of gauging like how do they feel about risk in general. And if I can tell that they're a little bit more reserved, they're a little pulled back, we'll go a little bit more towards the conservative side. Just even like anticipating, knowing that a market crash could be pretty significant for them, or if they just seem like you know what you're doing, just go for it, man. And I can turn it up a little bit as long as we're still within the confines of what makes sense for what they're trying to do. So to start off, again, we're going to start all the way at the bottom with conservative. So this risk tolerance indicates that the investor is not willing to tolerate large market fluctuations and is willing to forego significant upside potential to achieve this goal. Remember, if you think about this in terms of standard deviation, again, it's a really small channel where you're closing your eyes to what's happening out there and you're just walking and you're happy because you still got your bag and you're all right. But if we're going to go way to the other side, then they're just willing to open up that vision and they're willing to see all this crazy stuff happen and know that they're just going to keep walking through the fire until they get to the end. So this investor wants the portfolio to provide them with an income stream to meet living expenses most of the time. It's just kind of generally that's what these people end up being, is people who want lots of income. They don't want to see their capital go up and down because they're going to get scared that that income is going to go away. And we want to make sure that that person feels secure with their income and that the income is actually secure and it's going to stick around. And so for the most part, this is the kind of person who's drawing down a portfolio for living expenses, or have maybe a client that's doing like a lot of renovations on their house. Like, again, like we talked in some example, or we'll talk about some examples later, you don't want to put assets that are needed soon in super volatile indices and assets and funds, because then what happens if you get that one really horrible day and now suddenly you need to pull it and there's only 80% of your funds left. So they're more concerned with protecting principal than growing the portfolio. This is just that really defensive person that wants to hold on to the value. Maybe they've really worked their entire life to create this lump sum and they just hate the idea of seeing it down by 2, 3, 5, or 15 or 30% at any given time. And they would much rather just protect what they have and not see it go anywhere than try and do anything more. So the investor with a conservative risk tolerance would choose investment objectives of current income or balanced. And you can kind of understand why both of these are options if you think of how much time they have. So if you've got a lot more time, a conservative person would be totally good in a balanced fund. They might need a little bit of, financial therapy when the markets get rough. You might need to be there and support them a little bit. But in the end, that will still serve their objectives very well. And if you can really get them in the perspective of long term, then that's a really good fit. But current income makes sense for reasons we've talked about: lower volatility, income generation versus growth, lower standard deviation, all sorts of things like that. So moving up the ladder, we go up to moderately conservative, which is just a little bit of a step forward. This risk tolerance indicates that the investor can tolerate a bit more risk than the conservative investor, but are still averse to large short-term fluctuations. So you'd still not be even at like a 10, 11, or 12 standard deviation. You'd still want to be pretty low, maybe close. This is probably the person I'd have at maybe a 7 or 8 standard deviation, maybe even a 6. Just where it's really not too much. They're willing to take a little bit of risk. They're willing to see a little bit of loss, but they're not looking to see these big giant fluctuations and think about the next 20 years. Maybe they're closer to 5 or something like that. So they want to be protected somewhat from large downside market movements and are willing to not fully participate when the markets rally upwards. They're okay to watch the market go without them, and they just breathe and they understand that they're still safe because they know that when the market goes the other direction, they're going to be the ones laughing to the bank while all their friends are panicking and selling out of their S&P funds. Never do that, by the way, please. If the market crashes, hold. Just hold. It'll be okay, I promise. I'll give you a hug if you need it. So this investor understands that the portfolio will still fall when markets decline, but they want to be somewhat protected. They want some kind of assets that are just not going to feel that much of a crash. Those super short-term government bonds or any other like value stocks will not feel the same. So this kind of person, if we're looking at a portfolio and we have their equities and their bonds, probably lots of short-term bonds and probably lots of value stocks, because both of those don't feel the same volatility as the as their counterparts like the S&P fund or a bond aggregate index that includes all different types of maturities. These are the kind of people where it's going to be, I want to be in the market like everybody else, but not quite to the same level as everybody else. I want to feel that, but I still want to be a step back. So the investor with a moderately conservative risk tolerance would choose investment objectives of current income, balanced, or possibly growth in income. And again, you can think of least time to go, most freaked out about the market, most time to go, most comfortable in the market. Because you can have a lot of variation even within a moderately conservative risk tolerance. You can have some people that are a little bit more willing based on the circumstances, or people that are much less willing based on their need for the income tomorrow and the next day rather than 10 years down the line. So then we get our way to moderate, which again, middle of the road. This is where most people end up landing, right in line with balanced. This risk tolerance indicates that the investor is in the middle of the road category. They want good returns, and they know that they have to take on more risk to get those returns. And the portfolio may hold a wide range of asset classes, from short-term bonds to high-risk stock funds. So again, this is that kind of person who's looking for a little bit of everything. They're willing to sprinkle in all different types of stuff in their portfolio so they can feel the whole market and they can really get those diversified returns. And they want to take a decent amount of risk so that they can feel upside. But again, they don't want to go all in. This is not a 100% VOO or SPY investment sort of person. They still want to have diversification across asset types, because again, they don't want 100% risk. They probably maybe want, 70 or 75. They want a good chunk of it, but they still don't want to be that person where when the S&P crashes, they're having a panic attack in the morning. So this investor knows that they will lose money if markets go down, but they also expect to participate in gains when markets are performing well, just like we mentioned. The investor with a moderate risk tolerance would choose investment objectives of balanced, growth in income, or growth. Again, just kind of think about that time slider. And now we're moving to the more fun sections, more where I exist. Moderately aggressive. This risk tolerance indicates that the investor wants to outperform the stock market indices when the market goes up. Okay, now, to be honest with you, that doesn't really make any sense to me. This is not really what we're looking for. In my mind, moderately aggressive is pretty much like, give me S&P funds. That makes more sense to me, but we'll continue with it anyway. But they're aware of and accept the fact that the account will likely be down more than the market indices when the stock market performs poorly. The investor is willing to accept more risk than the average investor for the potential of greater returns. The investor with a moderately aggressive risk tolerance would choose investment objectives of growth in income or growth. So again, thinking of an investment objective of growth in income going to outperform the S&P 500 doesn't make any sense to me at all. So it's kind of a weird statement. I don't understand some of these definitions, but I'm just going off of what they tell me. But again, for me, if I'm looking at a moderately aggressive portfolio, I'm thinking of decently weighted into the S&P, maybe a little bit of high yield bond funds or something interesting, maybe some derivative income or something fun for the income portion. But I'm thinking closer to like a 70-30 or an 80-20 portfolio. That's kind of what I'm thinking about. And again, you can always think of, you can have different versions of this. So if I'm thinking about a 70-30 portfolio, there's a lot of different ways we can do a 70-30. I can do a 70-30 with all value stocks and all short-term government bonds, and that's going to be on the lower end of the spectrum. But I can also do a 70-30 with top 200 growth fund and a super high yield bond fund, or like a senior debt bond fund, something that I've been looking at, some alternatives, and those could be way riskier than the first version. So you kind of got to understand that no matter where we're sitting, no matter what percentages we're talking about, there's tons of modification to be done to make it more tuned to what you like. Yes.
When you say 70-30, 70 growth?
So 70 stocks, 30 bonds. Yeah. Yeah. So moving on to aggressive, this risk tolerance indicates that the investor wants to substantially outperform the stock market and is willing to accept the higher degree of risk associated with seeking returns that outperform. So at this point, we're talking about new sectors. We're talking about lots of growth funds, like their base would be super high risk growth funds, lots of small cap stuff, looking for those opportunities in smaller parts of the market, and maybe just looking at a lot of actively managed funds. Maybe they have some managers they really believe in that they think are going to do well. Really looking for those new areas, new markets that we can participate in that hopefully will do well. So I remember a while ago, for a while it was cannabis, and then nothing happened with cannabis, and those ETFs all just fell. It was like an 80% decline. It was really bad. I think they went up by like 30, 40, 50%. Some of them like doubled and tripled, and it was all looking great, and everything got super overvalued. And then we came up to it, and they're like, they're going to legalize. And then nobody said anything. It went completely silent. Nothing happened. Nothing happened at all. And those ETFs just went straight to the floor. So you understand that when you're looking at these new sectors, when you're looking at these different things, you're going to be taking on a bigger level of risk. But it's possible that if you just give it the right amount of time, that things will go through, that laws will get changed, and that it will become a really popular thing. It will become profitable and all this kind of stuff. And then eventually you're the genius. But for a while, you look like a moron. That just kind of happens. So the investor is very aware that a similar level of outperformance when markets are performing can negatively impact them when the markets are not faring well. They accept a high level of risk with the potential for greater returns, and they generally will choose investment objectives or growth or maximum growth. And with all this description, basically maximum growth. A growth person will be a little bit more conservative than what's said there. And then we get to speculative, which is just doing away with the index funds, doing away with any of the traditional stuff, and they just want to take bets. You might think of this as a hedge fund manager or active fund managers, all that kind of stuff. Like, it's their job to look for the next thing. Kathy Woods thought she found that with Tesla, and then her fund dropped by 50% right after that. But that's, so this risk tolerance indicates that the investor is comfortable with the highest level of risk and the highest average probability for loss of initial investment value in exchange for higher potential to profit from an anticipated price move. So we're kind of thinking of think of what kind of investments would fit in here. Individual stocks for sure. This is where we're taking gambles on individual companies, because the idea is that you're taking like some sort of calculated risk for just an incredibly outweighted return, where if your risk is 100% of what you put in, but you're expecting to see more of a growth rather than just like, oh, yay, I'm up by 150% over the next 5 years. Like, we're looking for that 1 year where it hits and you've got like 300, 400, ridiculous returns, stuff that you probably can't pick. Well, you might get lucky with one time. It's this stuff that we don't recommend that people do, but if it's what you're going to do, you got to have right risk management. You got to you got to understand the type of volatility that comes with it. So if you had just gone all in on Tesla way back when it was like $50 or whatever, that would have been a speculative move. It would have paid off, and for some people it has, but you would understand that if that company were to do poorly or fail, that entire investment gone. So that's kind of what you got to think about. Yes.
So that makes 300%. And then after that, then you take that money and then you change your risk tolerance.
Absolutely. And yeah, and that's kind of like, that's something that I really hope more people do, is when they do win big. It kind of like, if you have one of those positions that really pops out big, can you then at that point reevaluate and step back down and then distribute to a different risk level, which is what I hope that people do. Unfortunately, they think they can do it again and again and again and again. And then they just get into that gambler's mindset and they think, well, if I just keep going and keep going, then it'll be so much bigger and then I can have so much more to work with. When realistically, like you shouldn't be changing your risk level to like move up with the amount of capital you've made. You should keep it like relative to a nice small number where it's not like this giant risk of everything that you're putting down. So getting to speculative investments, that gets to way more about risk management and tactical investing and all kinds of stuff that we won't have time to cover in our class. But it's a fun thing to think about, and especially if you have like a little portion of capital, maybe a Roth IRA that just isn't really doing anything and it's not significant in any sort of way. Sure, why not? Let's pick a bunch of individual stocks and have fun with it. It's a good opportunity because, hey, if one hits really big, tax-free gains. So.
There must be a
Sure.
psychology of investing.
Oh yeah, absolutely. There's a lot to do with behavioral analysis is what we call it in the industry. There's a lot of different biases and what are called heuristics that we kind of look for with investing clients. And a lot of times you'll have stuff like recency bias where they will have participated in just this nice little bull market. And they think that it's just going to keep doing that forever. So why wouldn't I just buy the thing that went up by 150%? You'll have people that have anchoring bias. So if they made a ton of money on something, they're like anchored to that security. A lot of people that made a ton of money in Tesla, they just like want to keep doubling down because they made money in Tesla and they think it's going to happen again. So there's a lot of these different psychological things that that you have to take into account and really have to look at yourself, especially when you're making investment decisions, especially in a speculative nature, because that's going to play a lot. And you just kind of have to follow really strict rules and guidelines that you set for yourself. Yeah. Oh, yeah. Yeah, exactly. Yes.
These, like mutual funds and ETFs that you're talking about, when you talk about these investment objectives, like, are they standard classifications of growth or balance or macro?
Yeah, so,
standard
So the stuff that we're talking about here is mostly for when we're talking about a client. So when we're talking about a financial advisor-client relationship. But there are a lot of other, like the kind of classifications that would happen for ETFs would be stuff like growth, value, income, stuff like that. Those are the kind of things that we would assume. They're similar words. They're like almost the same, but these are more for client relationships, kind of what they're looking for.
Is the Economist a good magazine?
Sorry?
Is the Economist a good magazine?
Yeah, I mean, like a lot of.
Years ago, they were talking about this.
Yeah, I mean, a lot of these magazines where you kind of got to understand is like they're going to report on what's popular, like most of the time. A lot of, because that's what's going to, you kind of got to think about their value drive, right? So if I have a magazine, what do I want to talk about? I want to talk about what everybody else is talking about so that people come to me to talk about it, so that I get my clicks, I get my ad revenue. So it's kind of like, unless we're talking about a straight up analysis firm whose job it is to do analysis for capital, when you're thinking about magazines and stuff like that, they're super helpful to be in the conversation and to see what people are talking about. But you kind of got to understand is like, if it's hard to trust if they're going to be on it, because so much of the time it's like 10%, like this might be a popular thing or that might be a popular thing. But you just got to understand that like, no matter who you're reading, it's just to keep up in the conversation and do a lot of your own dig. Sure.
Right now, like, with all the reports that are developing in, I think of companies like Raytheon and General Electric to make submarines and that type of stuff. I think we're thinking about corporations that
Yeah.
make a lot of money and not making a lot of money from basically governments.
Sure. Yeah, and kind of one of the things to think about there is like you got to understand all the stuff that you don't see, because you never know like who's negotiating the contract. And you don't know who's going to sign the contract. And there's all this underlying stuff. You don't know if there's going to be some sort of political negotiation that now suddenly makes this event not. There's so much underlying stuff that we can make plenty of educated guesses. We can kind of look at flow and all those sorts of things, but kind of just like trying to make a statement of, I think this company is going to do amazing because they're going to make all this government stuff. And they got to wait until they win the contract. And even that could be like a 10% chance of you guessing the right person to land the contract. So a lot of these things, we get really speculative. We get down to just like a lot of analysis that you have to have a ton of information to make really educated decisions. And for the most part, like the firms have it way before you do. Like all the big firms, all the investment firms, they have the information way before you ever will. So like it just that's one thing that I will always advise is don't ever think that you're going to be before the multi-billion-dollar investment firms that pay hundreds of millions of dollars, tens of millions of dollars just for information, just for people in the right places, all this sorts of stuff. They have all of this power that we don't have. So that's why people who tend to invest in index funds and the like outperform by a lot, because so many people are making these, like they think they're educated, but they're really uneducated decisions because it's all information that everybody else already has anyway. So there's nothing extra that you've got.
But might be some, just wondering if it's local. Okay, for example, I was down in the wine country down in San Francisco area. I found out Harvard years ago bought a lot of vineyards, a lot of land out there to develop vineyards. Okay, now if you're a local guy, you know that there's land for the development of vineyards by major corporations, say like Harvard.
Mhm.
They could have bought, it could have been speculative, and maybe they could have been. I guess I'm thinking is maybe at a local proper that thinking maybe that company might be expanding because you live next door, you work for the company.
Yeah.
And you see some development trying to occur. So I guess we'll say that happenstantially, you might be able to see things developing because you're exposed to
Yeah, absolutely. And that's kind of, that is personally where I think a lot of the value comes from trying to be more particular and be a little bit more speculative, is when you just have sort of an awareness of the landscape of whatever it sits in. So I'll give you an example. My best stock pick that's ever happened was AMD. And this was before they were really like a big competitor to NVIDIA and Intel. I have been building computers for a lot of my life. That's just something I'm very familiar with. I know the hardware. I know the different things that people are looking for. And so I remember they had this big, they were doing a lot of development, and they were sinking tons of money into development, and they were starting to tease this whole new line of products called Ryzen. And it was this big, it was basically like a chip that they had been lagging behind on for decades. Like it had been since the early 2000s, since they had been a real competitor in this chip space. And they were teasing and talking about all these different things that they could do. And I just saw them dumping more and more and more capital into development and research. And I thought, we desperately need a competitor in this space. I want to see this. I really support the idea of this happening. So I bought a bunch of their stock. And I think I bought it around $10 a share. I think I sold it closer to $70 a share, something like that, just because like I believed in what was happening there. I believed in that market disruption. And I saw that as they slowly started rolling stuff out, I saw it may not be the complete competition, but I know they're at least going to step up halfway, and that's going to give them a lot of market share. So there was no guarantee that I was going to hit that play. I could have been wrong, and it could have been a complete fail, just like I was with Intel. They tried, completely failed. It didn't work out at all. Like the products came out, all the reviews were horrible. My investments didn't do very well, but I didn't, overload every bit of capital I had on that, so it didn't go too badly. But again, it's like that was one win that played out because I saw it coming, and then one that I thought I saw coming that just didn't happen at all. So it's really just kind of like making sure you manage your risk and all those sorts of things.
Okay.
Yes.
Historically, does the election change the stock market?
For a time, a little bit. It's usually like long term, yes, there can be some effects like, for example, some more Republican legislation can lead to greater growth in the markets just because it's a little bit more corporate leaning, gives them a little bit more freedom, or if there's more leniency for people to use capital assets and all those sorts of things, it can be good. In the short term, generally from some of the stuff that I've read, it can be pretty split whether it's going to be bullish or bearish, but it tends to be relatively bullish for some reason. There's like this nice little spike, even if there's a dip beforehand. But yeah, it's not, I wouldn't say the election itself is this giant major change for the market in a long-term perspective. If you zoom out far enough, you probably wouldn't even be able to see any of the elections significantly on a chart. But it's definitely something to where if you're coming up to it and You understand that maybe volatility will be magnified slightly if you wanted to tone down a little bit just so you didn't feel it. That could be a good idea, but you could also be missing out on really good days of the year. So it's kind of like when you average it out, it still just contributes to the long-term average, but it is something to consider where if you are not going to be ready for that short-term like magnified volatility where the standard deviation widens up a little bit, sure, it could be a time to take a look at that. But it's something that as long as you understand that you're still on the right path towards your objective, it's something I wouldn't like put too much stock into and just let it contribute to those averages over time. So obviously, an investor with a speculative risk tolerance will choose an investment objective of maximum growth, because why would they pick anything else? So these are a couple sample portfolios. When I use those like 70, 30, 80, 20 numbers, this is what we're referring to. So we're talking about a split between stocks and bonds. This has been the most classical way to divide up portfolios, and we're just keeping it super, super simple. Forget all of the fund diversification and all that kind of stuff. This is general numbers, general portfolios. We're starting all the way from 100% stocks to 0% stocks and 100% bonds. So in these portfolios, the stocks are represented by SPY, S&P 500 fund, and the bonds are represented by AGG, which is a bond aggregate fund. So that AGG is going to be a little bit too much weighted in long-term bonds for my liking, but again, this is all just for example's sake. It's not your portfolio. So we've got our 100, 80-20, 60-40, 40-60, 20-80, 0-100. These will be some of the most common percentages you'll see in a lot of advisor-built portfolios, but we're going to start talking about a couple different examples and when we might use some of those. So we're going to start with our first investor. So this person is retired, and his pension pays for 70% of expenses, almost covered. Distributions from retirement accounts pay for the remainder, plus a little bit of entertainment and travel. Like, I like to recommend that people have a little bit of fun, and this guy's having a little bit of fun. He's doing it right. So this investor desires to have some assets left over upon death for his beneficiaries. He wants there to be a little bit of growth so that there's something to pass on. We're not just drawing the assets all the way down to zero. And his risk tolerance sits right about moderately conservative. And he's got an objective of growth and income. So it's all pretty reasonable, pretty middle of the road, pretty standard. Now, right now, his current portfolio is allocated in 100% stocks, no bonds, beta is 1, standard deviation is like 16%, and these numbers are a little old, so now it's probably 18.5 or so. So what do we think about this asset allocation? I can see some people are already not a fan. So we don't, he's not doing too hot. We know that for certain.
It's not moderately conservative.
No, that's for sure. Okay, so if we were to say, like, look from this selection, what of these seems like it would make the most sense for him? Remember, most of his income is covered for with his pension, and there's a little bit of distributions that pay for the rest, and he wants to have some left over at the end. So if we're looking at this nice little menu of 6 portfolios, what would you pick?
Well, the first thing I'd ask is he married? Or does he have children?
Great. I like this. You're thinking like an advisor already. Okay, I heard an 80-20 back there. Okay, 80-20, any other ideas? 20-80, okay. All right. Okay, all right. I hear 20-80 and I hear 80-20. We're quite upset. All right, any other ideas? 60-40. Okay, let's see what I decided. I thought a 60-40 made decent sense. 80-20 might be a little aggressive, but depending on the size of the portfolio, that would make a difference. So both of you could be right. Both of you could be right based on the size of the portfolio. If the portfolio is a bit smaller, you might be right and say, we need to get that income because I need that to pay for stuff now. But if the portfolio is really big and a small collection of bonds could pay for those distributions, you could be right. Now, if the portfolio was just about big enough to kick off enough income to handle this situation and then also grow for retirement, then our 60-40 friends would be just about right. A beta of about 0.7, standard deviation around 11%. Now, in current market conditions, maybe closer to a 12 or a 13. Primary objective is growth because, again, we don't have a lot of expenses to pay for, just a little bit. But we do want to make sure that we have these assets left over for the kids. So we have a secondary objective of income, maybe a decent amount of dividend producing stocks, a lot of bonds to just kick off that income so that we can pay for stuff. So could we make the recommended portfolio a little bit more suitable? Like I mentioned, if the account's large enough for the income needs, we could consider a more conservative allocation or a more aggressive allocation. Like there's a lot of ways that this can work because like I mentioned before, if it's bigger, we could be more risky because we might want to grow it bigger. Or you could consider that the assets are already large enough and now we don't need to grow it and we could just shoot off income and not even worry about the growth. So you kind of really got to understand what size of assets do I want it to end at? What size of assets is it at now? How much income? All of these different factors play into what is ultimately your decision, as well as just kind of how you feel about it. Because if you say that there's enough assets now, but you really feel like you want to make sure your kids have the best life, you go for the more growth. But if you're really concerned that the stock market's going to be volatile and you need that income or else things are going to be a problem, then you're going to move more conservative. So it's a combination of that. What are we doing and how do I feel? So just making sure you're always taking both of those into account. Next person. So this investor is in college. Their parents are paying their tuition and they have a Roth IRA that contributed to with money from their fast food job. Assume they're dollar cost averaging, still contributing, all the good stuff. They got a risk tolerance of aggressive and their objective is maximum growth because what would income do right now? They can't take it anyway. They would be paying penalties, all that fun stuff. So it's put it in, close your eyes, let it ride. Right now, they've got a 60-40 portfolio. Just probably because this is what a lot of people said, this is the best mixture of everything. If you don't know what to do, just pick this and you'll be fine. So she's invested in 60% stocks, 40% bonds, beta of 0.7, standard deviation somewhere in the middle. So out of this menu of options, what might we pick? 100% stocks. And you'd be absolutely right. 100% stocks makes the most sense because what would be the point of holding the bonds? Unless you're going for some super crazy alternatives or super high yields or something just ridiculous that carries a ton of risk, there's no point in putting bonds in this portfolio. Because what are they going to do? Bonds don't historically have a big growth potential. They shoot off income and they lose a lot of value when they have long durations. So there's no point in having bonds in a portfolio like this because our objective is maximum growth, complete growth, maximum growth. We want everything to be used for growth. And they don't expect to use the funds for at least a few decades. And remember, with the law of large numbers, when we have those few decades, that's what gets us the closest to those average returns that you see measured historically. So if you're looking at an S&P 500 fund, if you've got 1 year, it's very unlikely that your average annual returns will be close to what's been measured for the last 40 years. But if you participate for the next 40, it's pretty likely it will be equivalent. Yeah, exactly. I'm basically just investing in a whole bunch of fun sector funds because I like to get interesting. I have a couple managed funds that I like. Provided they have, and this is also provided they have adequate emergency funds and health insurance. Because if you remember, with a Roth IRA, you can take out your contributions at any point. So you can kind of think of that as another place to hold cash. So if they don't have emergency funds, and this is the only stockpile of assets they have, maybe then you tone down the risk slightly, just so they have something to pull from if they desperately need to. But assuming that everything else is covered, or they just don't really feel like worrying about that yet, 100% into stocks, get that standard deviation up there, get that beta of 1 or higher, and let's go. So next, we have this person. This investor is currently looking for a new home. They've saved $100,000 for a down payment on the mortgage, and they expect to find and close on the house in the next year and have deposited the cash into a brokerage account for the time being. They have a risk tolerance of conservative, and they have an objective of capital preservation. Now, remember, these portfolios are just examples. And right now, he's in a 20% stocks, 80% bonds portfolio. Beta of 0.4, standard deviation around 7%. What are our thoughts? We think this is pretty good? A little too risky? Think it's too risky? Some of it, we got a couple head shakes. We think it's all right. So what I really want you to remember is one key piece of information. And it's not the risk tolerance. It's not the objective of capital preservation. Can anybody guess what it is? It's one super important piece of information in here. The 1 year. It's that time horizon. That super short time horizon. That's what I care about. Because yes, this might help us if it takes a couple years. If it takes a little bit of time, that 20% might help us out. The dividends will pay for the loss, whatever. But in 1 year, a lot can happen with the stock market. And if that 20% erodes by 50, and now we've got 90,000 instead of 100, that kind of changes how much house we can afford. That now changes what we're looking for. And now maybe we go to close and we go, oh crap, like I don't have the capital for this. Now I got to generate it through my own pockets. So again, I mean, the answer is pretty obvious. We're going to go with a 0, 100. And we're not going to, you know, in a real scenario, okay, I guess the question's asked in the next slide. So what can we make, how can we make this better? Instead of using a bond aggregate, use a short term, ultra short government or a money market or something that you're almost certain is just not like, it's not going to move too much. Money market will be a really good bet because usually their most volatility is when it drops from $1 to 98 cents. And then it comes back in a few days or a few months. So because of the incredibly short time horizon, we would focus on ultra short-term government securities, which provide incredibly high credit ratings and low duration, reducing the overall fluctuation in the value of the portfolio. So there's a couple different factors that we can now look at that impact risk tolerance. So if there's a substantial change in assets, time horizon, or cash needs, it's likely that our objectives and risk tolerance could change as well. All of these factors directly impact the objective by changing the scope of the investment strategy. More time means more acceptable risk. Greater cash needs require more stability. So let's think about the situation of sudden cash needs. So if we have an example of a 60-40 portfolio, but 20% of the portfolio needs to be liquidated in the next year. Say, for example, you have something horrible happens to your house, there's a big fire, some kind of disaster, maybe you're in one of the hurricanes, and maybe insurance didn't cover it all the way, and now we just need to pull a bunch of assets in order to pay for it. Now, we do have that 40% in bonds. We're ready for this distribution. We're good. We're all right. We can pull that 20% out and we're okay. However, by doing that, we're also reducing the amount of bonds that are in the portfolio, and now we're overweighting the portfolio to equities because the asset amount has dropped, but the amount of equities has stayed the same. So now the portfolio is too risky. So what we have to do is we have to compensate for this loss in cash and increase our bond allocations beforehand so that we can distribute it out and not have it affect our plan too harshly. Receiving a substantial pension. And it's not likely that you get surprised by a really big pension, but let's just use that as an example. So let's say you've got your 60-40 and now you don't really need distributions anymore. Let's say it's something that you're not required to take distributions out, or the distributions you were taking were much bigger than RMDs. But now you've got this pension that pays for so much of living expenses. In fact, actually just covers them, period. So now you don't need to be taking these distributions. You don't have an income need. There's no need to be taking money out. So now we can look at the pension and we can think of its present value, which is basically if you take the cash flows that are coming out and assign it a lump sum value today, you can think of that like a big government bond position. You can think of that as like a big long-term bond that you've bought into that you're just going to hold until your death, and you just keep getting that paid out, and it's pretty much guaranteed. So the pension then can serve as our bond allocation. And then we can look and we go, oh, okay. So now if I have this 60-40 and this giant 0-100, it averages out to a very overweighted bond position. And so now I think, okay, since I don't need to utilize this account for income generation, I can overweight it towards growth. And now I can go back to my 60-40, but my investment account is the 60. That's the 60 and my pension is the 40. That's kind of what I talk about when I talk about comparing other outside assets or streams of income to types of securities in your portfolio. Because realistically, we are talking about a brokerage account or a 401k or an IRA, but really these ideas should be applied to the overall picture. So the objective of this investment account changes to growth or maximum growth. It gets all the way up there, and now you can take a whole bunch of risk. But what about retiring earlier than expected? You got your 60-40 again, and you become disabled 10 years ahead of your planned retirement date, and you need to retire early. you were expecting a lot of time to go from 60-40 to 55-45 to 50-50 to and further until you get all the way down to a 0-100 or a 20-80 or whatever your end goal was. So Social Security is not going to cover the living expenses, and the portfolio is not quite large enough to suffer from substantial equity losses and continue paying sufficient income. So basically think about it this way. We're at a point where the portfolio is just about big enough to where if we take a little bit of risk, just a little bit, we can get that little bit of inflation protection, but we need to hold on to that income because we need it to pay out regularly. We can't risk losing out on income that's going to cover our expenses. And if we take too much risk, the portfolio value drops, and now the yield also drops along with it, and maybe it just falls under what we need to cover our expenses. So at this point, the portfolio becomes too risky, and the objective changes from growth in income to current income. While we could have been focused on growth and shooting off a little bit of income, now we've gotten to a point where we go, whoa, hold on. I need to back up, because if I need to pull out extra money out of this portfolio to pay for my income needs, I need it to not be so volatile. I need it to not lose a ton of value as I go to withdraw it. So then you rebalance the portfolio to majority bonds and dividend paying equities. You reassess what you're trying to do with these dollars and give them a new objective. So it's time to recap everything that we've been talking about. We've talked over a whole lot of stuff in this because we've been talking a lot about the investments. We've gotten really technical. We've gotten a little bit more broad. We've talked about a lot of different stuff. So we're going to go back over it on a very kind of top-down broad view. And this would be the time where if you've got questions about any of these topics, please ask them. Yes.
Process 4%.
Yes.
Does that address inflation as well as capital preservation?
Ooh, that's a good question. I don't think it takes inflation into account, because essentially what it's doing is the 4% rule is basically, if you're unaware, there's been a ton of studies done through historical data of what kind of withdrawal rate you can take from, I forget what the allocation is, it might be a 60-40, there's some sort of like allocation that they base it off of, but there's some amount that you can take out every single year, and basically the account will pretty much always replenish it back and continue on. So that withdrawal rate of 4%, where you take out 4% of the account every year, has a success rate of like 97+%, where in almost every single circumstance and every single section of the market, no matter where you break it up, it seems to do all right and survive. Now, there's just a few little moments in history where if you were in just the wrong time, it would have wiped out your portfolio and you would have run out of money. But for the most part, what the 4% rule is saying is that if you take out approximately 4% a year, some people are saying now it's 3, or, the numbers change all the time. But generally about 4%, if you withdraw that every year, your portfolio should maintain value over time. When markets go down, sure, it will dip, but you're not withdrawing so much that it can't recover. That's kind of the idea of the 4% rule. So it's not really so much of an inflation number. If you started adjusting your withdrawals for inflation, that would probably give you a much more skewed idea, because now you're going to have to start withdrawing larger portions of the account, like 5 or 6%, because your inflation adjusted costs are higher. So it gets kind of complicated.
Would it add enough growth? I guess maybe the deeper question is, what allocation would best fit a 4%, 60-40, or?
I would say something around the balanced, if not maybe just slightly more weighted towards growth, maybe somewhere between like a 65-40 or 65-35 or something in that slightly above the balanced, I think would probably, I don't have the exact data to prove that right now, but that's kind of where I think you would be the most comfortable. Yeah. So let's begin our recap. Oh, yes.
It's really conceptual right now.
Yep.
But when you start talking about dividends and, starting, income generating.
Yes.
It's like the tax efficiency built into it as well. Like, how do you make sure you're not like losing money because you're dealing with net versus.
Right. Yeah. So that ends up being a very, very particular kind of circumstance question, very much based on the individual client needs. And then it also kind of depends on, what kind of accounts you're generating the income for. Because if you think about, if I'm generating income for an IRA, it does not matter where it comes from, the taxes are going to be the same. When it comes out, it's all going to be paid the same. If I'm generating income on an individual brokerage account, or a joint account or something like that, it's going to be a lot different. And it's going to depend what income level my client is at or what income level I'm at when I'm distributing out that income, because dividend income will be ordinary versus the capital gains or the capital gains tax. So it kind of really depends, and it also a little bit depends on how close you are to a bracket. So if you've got like a little bit of space, if you got time before you bump up and now your effective jumps a little bit, you can be a little bit more, just give me all the taxable dividends because I got some more room to go. But if you're towing that line, that's where you got to start getting a little more particular, where if that's going to make a difference for you, and for the most part, because the taxes are progressive, it's not going to be as big of a difference as some people expect it to be. But that will be kind of where you're thinking, okay, how much income can I take? How much of this do I need to be tax-free? Pull that into munis, all sorts of things. So again, it's really particular, but that's kind of where I'd be thinking about the municipal bonds or the treasuries, all sorts of stuff like that, kind of getting that balance between those dividends and those tax-free
Could it be an
things.
exercise?
Absolutely. I think it definitely would be, because that'll also depend on, like, if your dividend stocks, like, if the yield increases for some reason, like if you got 3% one year and you got 4% the next year, you go, oh, that's going to be an income jump for me. And now you got to, so that's something where it's going to be pretty particular. And I would definitely be doing an annual review. In fact, if not maybe quarterly, just maybe paying attention to the distribution schedules of the funds. That would be a really important piece of information. If I've got a taxable income fund and I'm really concerned about income, I'd want to be paying attention to those dividend and capital gain distribution schedules and seeing, like, what does it look like? What's the dividend growth year over year? What can I be expecting? And kind of taking that into account. Yeah. So let's get back to the beginning. Remember the two core components of portfolio building: lateral integration and vertical integration. You remember, lateral integration has to do with our timeframes and our objective-based allocations to manage systematic risk. You remember what systematic risk is? That's that general market risk. That's just fluctuations, standard deviation, all the kind of general stuff that we're feeling. And then vertical integration. We've got diversification of our allocations to mitigate unsystematic risk. Make sure we're not feeling individual stock risk, financial risk, country risk, just any of those things that come down to small, concentrated exposure, individual stocks, stuff like that. That's what we're going to use to avoid those risks. So we're not necessarily aiming for the best returns, because if we wanted the best nominal numerical returns, generally you just buy an S&P fund, close your eyes, and wait another 20, 30, 40, 50 years. But rather, we're looking for the best likelihood of success given the stated goals for the portfolio. So there's something called Monte Carlo analysis, where you essentially can plug in all this different information. There's a lot of retirement planning software out there that can do this. So your advisor might have access to that. But a lot of times you'll plug in all of your factors, and then you'll say this income and this investment portfolio and this real estate and blah, 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 all the different stuff in there, your tax rate and your age and your Social Security, and then it'll calculate out sort of a percentage of success at the end of it. Or you can bring it down just towards an investment portfolio and say this much distribution, this allocation, this much time. How much of a chance have I got? So when you're doing a Monte Carlo analysis, you want to get that percentage as high as possible. 90s or greater, 95 or better is what you want. And essentially what it'll do is it'll take that information and go back historically, kind of like they did with the 4% rule. Similar thing. We'll go back and see how many times did that work out? How many times did this succeed in all of my historical data? So you're really just trying to aim for, and a lot of advisors have a pretty good intuitive sense for what kind of lands you in that area. So while they use a lot of quantitative stuff, just a lot of experience also can help as well. But you're just looking for the best chance of success, the best chance that over the long term, the portfolio will maintain the objectives and continue to do what it was assigned to do. So remember, An investment account can be part of an overall portfolio, and it can be evaluated on its own. How it fits into your overall picture is up to you. If you like to segment things and go this for that, and this for this, and this thing, and you like to break everything up, that's personally how I like to do it. It makes the most sense to me, because if I can look at investment accounts and say I've got an IRA, I've got a Roth IRA, and I've got an individual, for me it makes a lot of sense. IRA is probably going to be the most balanced. Roth IRA is going to be the most aggressive. Individual is going to be the most conservative. For tax efficiency reasons, for the reasons of having that individual be a cash reserve, just for me, it's very intuitive to segment things and look at them on an individual basis and say, this is for that, and this is for this, and categorize things that way and invest them on their own. But you can also pull back and look at everything in big picture, especially if you're evaluating your income needs from a lot of different types of assets like real estate, like pensions, like Social Security, like your investment accounts. All of that, if it's all going towards the same objective, that would be a great time to look at it as all one big pie. But again, it really is up to you how you like to view it, and just choose what makes the most sense for you, like what you can grasp the best. That will give you a better chance of succeeding, because the better you can understand what you're doing, the better you can understand if you're doing it well. So remember, we've got basically, here's the big graphic representation of how we handled lateral and vertical integration. Remember, we started with our 3 stages where you have your most immediate needs, could need, could not need, and definitely don't need for a while. And then also that completely depends on the portfolio as well. And then remember our diversification sort of pyramid, where we start with broad, lots of diversification, super low cost, to bias towards that. So that if I'm creating an equity allocation, I might put an S&P 500 fund in here because I know I'm diversified across companies. It's not likely that if one fails, the whole fund fails, and the cost is usually very low. And then as we move up, we might get a little bit more particular factor funds, more passively managed ETFs and things like that. And then as we move all the way up to the top, we can start to have a little bit of fun with it. Very tightly concentrated active funds or sector funds, all sorts of stuff like that. But just making sure that those super high cost funds stay up there at the top so they don't make us pay a lot on the grand scheme of things. Overall, we want to pay very low fees. And if you wanted to make a really simple portfolio and not really worry about the top 2 levels, you could just deal with super low cost index funds, short-term bond funds, sorts of stuff like that, and do just fine, probably perform just as well as everybody else would anyway. But I like a lot of variation, so I have a lot of different things I can control and put my hands on. It just it gives me a little bit, I feel like there's more buttons for me to push and to pull from and do more things with. So again, if we kind of reconfirm all those ideas, we're using that vertical integration in all of our stages to make sure that we have proper diversification, as well as biasing towards those low-cost investments. And remember, these are the different types of risk that we're working against. Systematic risk is what we're managing with our lateral integration. Purchasing power, reinvestment rate, interest rate, market risk, exchange rate, all these different things that we really can't control much of our exposure to. We can control the degree of exposure that we have to it. My interest rate sensitivity will be a function of how much I have in bonds, as well as how long the maturity lengths on those bonds are, and the coupon rates, but those are the 2 main things. Market risk is going to be how much I'm invested in the market. If I have my money in cash, I don't have really any market risk, but my purchasing power risk is sure high. So it's kind of just, systematic risk is really just figuring out where your balance is. You're going to have to feel all of them at some point, but it's just understanding, where do I want to bias towards? What am I okay feeling? You can't diversify them away, but you can manage them. Unsystematic risk, remember, this is basically all the stuff that just comes with individual stocks, really concentrated fund investments that are really on one particular type of industry or anything like that. So all of these can be diversified. These are the things we manage by just having low-cost, broad-based index funds. As soon as you put like a total market fund, this basically gets killed. It goes away because you just have so much diversification. You're spread across so many different types of assets that it just, you're not so worried about individual companies. Now, it could be argued that you actually still have some unsystematic risk because of the Magnificent Seven, because of how big their allocations are in all these different funds. So that might be something that you consider, but you can also consider the strength of those companies and the likelihood that they're actually going to fail. So again, imagine your 3-layer pyramid. Imagine that at the bottom, we've got total market, low cost, your short-term government bonds, whatever it is that you're investing in. It's those index funds, super low cost, tons of broad exposure. You basically got no systematic risk. The further up or unsystematic risk, the further up we move, the more unsystematic risk there is. The lower down we are, the less unsystematic risk there is. So there should be basically zero at this level. That's why we have those total market, broad-based index funds here, because you will not get that unsystematic risk, but you'll get tons of systematic risk. And then we move up and we get a little bit more particular sector, factor, other passive funds. That's where we'll pay a little bit more. Maybe even not sometimes. Some of these sector funds can be pretty inexpensive, but they're more concentrated. So a tech fund is going to be more sensitive to particular things than a total market fund is. A utilities fund is going to have a different exposure level. A value fund, consumer discretionary, consumer staples, all these different sectors in the market are going to have individual risks that are associated with them and individual economic things that can affect them a little bit more strongly than just a big broad-based index fund. Then we get up to our managed funds, other more speculative stuff all the way at the top, making sure that our highest fee funds are up there so they don't cost us too much in the long run. And then we also just have this basic allocation guideline we ran over. And really, this is just, if you just have no idea where to start and you pick a bunch of funds and you go, well, I've got all my funds, but how much do I put in each one? This is kind of just a rough place to start at. And then you can adjust it to get all those risk measures to where you want. So if you just have no idea, you know kind of where you want your standard deviation to lie, but you don't know what combination will get you there, kind of lay out all your funds, look at this, think of where they all go, and then allocate them this way, see how it ends up, see how much risk you get, and then just start to kind of adjust things up and down until you get to the right place that you're at. And then we created our sample portfolio here, which was our balanced portfolio with a standard deviation of just under 10, right in that middle ground that we were talking about. And those are the different funds that we were using. SGOV is my favorite short-term government bond fund right now, mostly just because it had the highest yield out of them all. It was like 5.2 or 5.3 at the time I was looking. LDUR is a actively managed short-term bond fund. And then VRP is preferred stocks, hybrid securities. Stage 2, we had our S&P fund from Vanguard, a value fund from Schwab, and a little bit of high yield bonds also from Schwab, I think. Was it Schwab or iShares? I don't remember. And then in stage 3, we had our more fun things like IWI, which is the growth ETF. VEU is a that's international. It's like a global fund without United States. So that's kind of what I like to use for that international component, is it just kind of captures everything and then kicks the US out. Because I find a lot of these global funds also include the United States. But if I'm gonna, like, I already have my S&P fund. Let me do that myself, please. So that's why I like VEU, because it's just everybody except the United States. And then XSMO, which is pretty much it's like it's passively managed, but it's a little active because they use factors that are kind of proprietary in there. It's the momentum factor, whatever that means. I don't know. It's up for them to tell you. But then this kind of landed us at around 20% or 0.20% average expense ratio, standard deviation a little under 10%. And we talked about evaluating investments with Morningstar and how we used it to basically use their comprehensive, in-depth look at investment products to help us choose what we were going to use for our portfolio. And so we'll just briefly go over all these metrics. So if you have any questions on any of these, please, now is the time to ask. So we had our relative risk return metrics, beta, which basically just gave you an idea of the volatility of any given investment or portfolio relative to whatever index we're comparing it to. So remember, a beta at about 1.0 has the same volatility as the index, usually the S&P. A volatility below 1 is less volatile. Above 1 is more volatile. And it's basically like a percentage. So if you see a 0.7, it's about 70% is volatile. Alpha refers to excess returns on an investment above the benchmark return when adjusted for risk. So however much better we did than the index for the level of risk we're taking. R squared was a percentage of a fund or securities price movements that can be explained by movements in an index. So basically how much in the S&P dictated what happened for me. And then we have our non-relative or isolated risk and return metrics like mean return, which is just the average yearly return based on previous data. Standard deviation, which measures how far around that mean return we tend to be. So if we got a mean return of 10 and a standard deviation of 10, we could probably go up to a positive 20% year or a 0% year with a very strong likelihood. That's a pretty common year for that asset. But always remember that you can step outside of standard deviations. It's by no means a requirement that your asset stays within your little channel of standard deviation. It can fly up and down pretty strongly. Sharp ratio, basically like alpha, but instead of using a relative measure, we were using just the volatility of the asset. So based on the standard deviation, how much better did we do than if it was just what was due to standard deviation? And then we talked about some bond-related stuff. Average effective maturity, which is basically just the average maturities of all the bonds in the portfolio. How long do these bonds last on average? If I got a bunch of 10s and a bunch of 5s, probably going to average around 7. An average effective duration, which we were more concerned about because average effective duration basically takes the maturity and then it takes the yield and it kind of puts those together and gives us a better measurement of how sensitive to interest rates we're going to be. Because if both of us have a 10-year bond, I'm earning 10 and you're earning 5, if interest rates go up, you're going to hurt more than I am because I'm making more money comparatively. Then we talked about credit rating a little bit. Basically how everything above the red line is investment grade or good enough for a good investor, a prudent investor, and everything below is junk bonds or high yield bonds, which is where you're taking a lot more risk to earn more yield. Generally, right now, above the red line, you're going to get between 3 and 5% is what I'm seeing, and below might be between 5 to 8. That's kind of just generally where we're at right now. So that was a lot of information. There's a lot going on there. Even just in that little review, that was a big package of information. So if there's anything about the portfolio construction or the investment process, now would be a great time to voice your questions and we could talk about basically whatever you want.
Yeah, just all back there.
I'm working on it. It's not quite accurate yet, but I'm working on it.
I have to talk to friends about how the interest rates, when the federal interest rates going to go down, how that's going to affect bond rates as well as stock.
Yeah.
But we're just grabbing numbers out of the So is there data to support that as the interest rates go down, stocks automatically go up?
So there are a couple things that can support that. And I'll talk about it kind of like if you get down to a fundamental level, what does support that is because when interest rates go down, money gets cheaper, which means that debt is easier to acquire. So a lot of the times that means that companies with momentum can scale faster and they can do more things more quickly because they can take on more debt. And that's just kind of generally what goes on to kind of drive the stock markets going upwards. And as well as on the equity side, when we're just talking about the stocks, not the companies themselves, we're talking about stocks. When interest rates go down and suddenly my savings account stops paying 4.5%, why am I going to leave a whole bunch of money in my savings account when I could go earn 6 or 7 in the market? So it's kind of that trade-off as well. So you've got the money becoming cheaper and the companies are able to invest more, as well as the investors don't want to leave it sitting in a stable asset anymore because it's not doing anything for them. So then more money flows in, which increases, and it just kind of is this thing that cascades upwards and continues. Yeah, so there is definitely data to suggest that lower interest rates can push equities markets, but again, there are other factors that can take precedence over that as well. So it's kind of like understanding like with whatever happens, if at the time that the interest rates go down, is there enough like freedom and like not so much weight on these companies that they can take the advantage of that free money and people are going to put their money in? Is sentiment good enough that people are actually going to move out of stable assets and now that they don't get that yield? So it's a lot of different questions, but theoretically at the base of it, what I talked about it just a minute ago. Yeah.
Which one?
So I will just like, I would be thinking about, they're able to invest more cheaply. That's a really good thing for equities to go up. And the people are going to move out of treasury bonds and savings accounts. They're going to invest in the market. That's going to drive equity prices up most of the time. Sometimes it just doesn't happen. I hope so, but okay. Anything else? Yes.
Like other macroeconomic indicators like employment or housing starts or.
Yeah, sure. It does, but like, I'll just be honest with you, so many people that take that information and then try and enhance what they're doing with it, they just don't. It almost never, like people make so many predictions and then you'll hear the one guy that happened to get it right. But look at his track record for the last 110 times he called for a recession, Michael Burry. It's just like you can make 1,000 predictions and you get one right and everybody thinks you're amazing. And so it's just like it just doesn't line up so much of the time. Again, partly because there's so much stuff we don't see. Like so much of the stuff that has the most grand effect on the stock market is stuff that none of us ever thought about because it just wasn't even in our purview. All of this like information when it comes and it breaks and now suddenly the stock market does something wildly different. None of us could have made a move on that because none of us knew. So that's just kind of what I end up seeing where, yes, I like to think about those things short term. And so what I mean by that is thinking about if I have somebody that really needs to make sure that their risk is low, if I can anticipate where volatility is going to increase. So for example, we were talking about the stock market with the election. I'm going to say it's probably pretty likely that stuff's going to get hairy, whether it's positive or negative, when the election happens. Volatility will increase. If it's something that I need to pay attention to and I need volatility to stay low, then I'll de-risk. Understanding that I'll miss out on something positive, but I'm reducing my volatility. Same thing if we're looking at bonds. So if we think interest rates are going to change and we can't take that volatility, I'm going to de-risk it. I'm going to sell off my long terms, my intermediates, so that I don't have interest rate sensitivity. Or with real estate holdings, if it feels uneasy and we think that there's going to be extra volatility, I might pull out of real estate holdings or see what contains that. So really that's what I'm thinking about, is if short-term volatility is going to be really detrimental, then those different factors, because either way, if we all know something is going to happen, but we don't know which direction it's going, that still means volatility, and it still means a greater degree of chance that something could hurt when I'm doing short term. So that's really where I'm looking in that sector. All right, anything else? Okay, and in that case, that brings us to the end. That was a pretty good class. I think we wrapped up decently well. And now we are finally finished with our portfolio construction. Hopefully you're all really good at making investment portfolios now. Tell me how you outperform the stock market next time. All right, thank you very much. Hope you all enjoyed.